Hey traders, Ragi here, and in tonight's Simpler Forex free video, we're going to talk about how to manage a trade once it's turned into a winner and the importance of the first profit target. I'm going to use two current trades, one in the Euro US dollar, the other one in the US dollar index futures contract. Now, a lot of people think currency trading is just Forex, and that could not be further from the truth. Currency trading really is applying a macro lens, if you will, almost like a fisheye or a wide angle view. It's a panorama. Pick whatever camera lens you want to pick. But what it does is you look at all the interconnectivity between a currency, the underlying equities market for that country, the important commodities that are either exported or imported from that country, central bank tones. I mean, all these tie up. And while on the surface, it might seem confusing, once you understand how these really are like dominoes that fall, or even just, threads that are woven together, you notice that there are multiple opportunities once you see all the moving parts and pieces. That's what's so exciting about being a Forex trader. So let's start this convo off with the euro versus US dollar. Now, this was a pure trend follow. The reason I'm taking a look at the Euro US and the US dollar index is because they are very similar. 57.6% of the US dollar index basket is actually euro. So they have a very tight inverse correlated relationship. So if one goes up, the other's going down, and you can see the inverse trends here. So when we pull back to the 1305, we had an aggressive setup, which is to say we put in about 1/4, 1/3, no more than 1/2 of our overall position size, and the remainder goes at the conservative, the 1255. I threw an optional profit target in at 1345 because I typically don't let the dollar index dictate what I'm going to do with the Euro US, because that would kind of like be letting the tail wag the dog. The Euro US is the most traded pair in the largest market, the Forex market, so it does take precedence over the dollar index. But when the dollar index starts hitting major psychological levels, I know the bid in the US dollar index could create some resistance and stack the offer on the Euro US. So I thought, you know what? As we hit 94, let's make sure we're being preemptive about the exit. Now, here's where the trade management comes in so importantly. And that's understanding that if you get too greedy with your initial profit target, you, one, don't realize a profit, and two, here's the most important part, you aren't able to ratchet to a break even. So often traders get very greedy with that initial profit target, which is where we would officially call the trade a winner. And by not realizing a profit, and I won't say quickly, but at one of the more near-term hurdles, we can never go to a break even. Now, what's another way that we can quantify? Let me take you over to the auto chartist here. What's another way we can quantify what a reasonable profit is? Not in terms of dollars, because that's completely arbitrary and individual to the trader, but in terms of how much could a pair move. So I can take a look at the average price movement of about, let's call it 80 to 100 pips. Now, somewhere in the vicinity on a daily time frame of 80 to 100 pips, I would say, it probably makes sense for me to start reeling in the trade. Now, the conservative is what I'll usually use, not the aggro, because the aggro, of course, is aggressive and doesn't always have a balanced risk-reward ratio. So I go with the conservative and I say, whoa, as we're going through 1345, I'm not only going to be moving into some resistance, I'm going to be dealing with a major psychological level. And oh, by the way, I've seen a 90 pip profit. And that's how I keep from, a lot of traders, just especially if they've had struggles in the past and losing trades, as soon as a trade goes positive, they want to start taking it off the table. They inevitably smother the trade, and they never are able to really get everything out of the trade that they could. And this is one way I can quantify to those traders, hey, hold out for about 80 to 100 pips before you start to reel in the trade and realize a profit. So we're very tactical about it. We try to be as objective as possible. So again, the dollar index was a short that we took, and this would only hit the aggressive level. So I don't have as many lots in the US dollar index as I would like. And that's okay. I don't have this position size in this futures contract is a little bit lighter than I would typically have because I wasn't able to get the conservative. So I saw a 95.30, which I was holding out for, but then we had the 94.95 agro short. But again, 1/4, 1/3, maybe 1/2 of my position size. So because I had 1/2, now that I've gone through 2 profit targets, I've seen 1/2, 1/4, and now I'm left with only 1/4 of my position size. On the Euro US, on the other hand, I've hit the optional, so I only took 1/4 of my position size off the table. I've moved to a break even. I still have 3/4 of my overall position at work. And so understanding when a trade is a winner, how to ratchet, how much room or how much pip movement you could expect before you even should consider taking a profit. These are the kind of things I wanted to show you in tonight's video. Hope it was helpful. See you in the next update.